Hi there, and welcome to this month's edition of Real Estate Matters with Clare Girton and myself, Ayse Clay. This is a show about, one, that real estate matters, matters in real estate, and how real estate affects us and our local selves in our neighborhoods. For some, real estate is our largest investment. Both Claire and I are residential realtors focused right here in the main line and surrounding areas. And we continue to be in interesting times in the real estate market. So we aim to bring you stories, scenarios, and some terms that might assist in the understanding of residential real estate. And we hope to tie in a little bit of humor as well. So good to see you, Claire.
Hi, Ayse. Always good to see you. I'm excited about our conversation today because this is something that I've been really curious about, thinking about as we continue to do our work in our profession. We're constantly looking at how things are changing, right? We're watching how the markets are flowing, going up, going down, staying the same, and how that affects not just buying and selling, but other investments and things in our portfolios, in our personal financial portfolios, as well as our professional. And so today, I'm excited. We're going to dive into talking about residential rentals and in relationship to investment properties. And I know we're lucky to have you in our world because this is something that you actually have firsthand knowledge in. You own a few investment properties with your husband, yourself, and you also help other investors in your real estate business. True?
I do. Very true. So thanks for that intro.
Yeah. So I was hoping that we could kind of start and just bounce some questions off each other and see kind of how we can dig into this topic. And so first of all, people talk all the time about investment portfolios and properties and in this market, and is the market going up or down or where are we? Is now a good time to invest in rental properties or investment properties?
Great question. I'm going to take it back for a moment to say I'm not all-knowing. A little disclosure, I'm not all-knowing in all things residential real estate.
But experienced.
Yes, I would say about 20 years of, when I started at least, of experience of residential rentals and being a landlord. There are other types of vehicles for residential renting. When you go over like 4 units in a building, that becomes mainly more commercial renting, even though it's in the residential realm.
That's a good point, that there are many rentals out there that are leasing companies or real estate companies.
Exactly. Lots of residential real estate. I'm going to focus on maybe more of a small-time investor, so to speak, point of view, as we have 7 properties total, where I know some investors, they're hundreds of properties. So kind of small-time investor in residential real estate.
Can you tell me a little bit about how you got started? How did you start the process of your investment properties?
I think looking back, my mom and my uncle and aunt, they had started prior to me. I think they were like first generation to have an investment property here and there, which was really cool to see and to kind of, I can't say I understood it all at the time, but to see what they were looking at and how they were working things. I started out initially, I was in real estate. I was helping customers out mainly with their buying needs. And in real estate, we make commission checks. We don't get paid every Friday or every other Friday or every month. And so when we do get paid, it's more of a lump sum, and then you have to parse it out from there. However,
and plan for that.
Absolutely. Plan for expenses coming up. I figured that money in my hands would just be easily spent. And so to be able to buy something that would help me later on was something that was on my mind. In real estate, I'm speaking as an independent contractor. We don't have 401ks. There's like a SEP IRA and things like that, but traditionally our companies aren't giving us a retirement package or a retirement plan or health care. So I thought this long-term would hopefully be a retirement vehicle for myself, and hopefully along the way, additional monthly income. So I started out initially with buying my first house, and then kind of small-time investor, I always had a roommate to help offset all of the costs.
So you lived in your first property and and then rented to a roommate, and that's how you began.
Pretty much.
And then you kept that house.
Kept that house, so kept it.
Once you moved out.
2 years later, I moved on to something different, and then that became my first investment property. And speaking of that, because I lived there for 2 years, and I'm sure of this certain rule now, maybe it's just one, you have to live in it as an owner occupant if you're getting an owner occupant mortgage.
Right.
But moved on 2 years later, so my interest rate was owner occupant, which is traditionally lower than investor mortgage. My down payment was lower, but that didn't truly help me. It helped me acquire the property, but monthly payment wise, I wasn't really, and renting out the property, that difference between my mortgage and the rent was not vast.
Right. But it gave you some ability to build up some equity in that property. You had an initial, what we call a primary mortgage, because you were an occupant. So say a little bit more about that. Once you move out of that, and then it became a full investment property, and you wanted to buy another investment property.
Yeah, so
you weren't going to live in.
Yes, you get to keep that that mortgage as owner occupant mortgage, and
because it was on the books that way.
Yeah.
Yes. Okay.
Exactly. Which is great. So you get to keep that, ride it out. The second property that I purchased was in a university area, and interestingly enough, it came with a tenant. It didn't have a school student in there, or a university student in there, although that was a greater of the market in that area. I purchased it with the tenant, which was different from before, so very different scenario. At that time for investment properties, you only needed 10% down, which was the minimum for investment properties. I can't say now it's 20 because there's other ways to kind of structure it, but 20 is a good earmark, if not more, as your down payment. So that was a little bit of a different way to go about it. The tenant didn't know me, so there was a little bit of a learning curve for both of us. I inherited the current lease that was in place and saw it through. The house had a detached garage that the tenant was using. So upon years later, when that tenant moved out, I saw the opportunity to break off the garage from the home lease and rent out that garage for
separately.
As like $100 a month, which I continue to do nowadays. So kind of like looking at your investment and how to maximize that in the best way, shape, or form. That wasn't my initial idea. I saw my mom and my uncle and my aunt having kind of a similar property, and they also broke their garage off. So I'm not saying I was pure genius, but just looking at it that way and how to really maximize the money that you're putting into it and getting out.
Would you say, for people who might be thinking about this at their first investment property, there's a little bit of a trial and error there. There's a
every day, Claire,
and that there's some risk there. That sometimes it may feel a little risky, and in the idea that it may not float, but that you start to get a little bit more experience as you go.
Yeah, at that time, I think I was okay with failing forward.
Yeah. Say more about that. What did you mean? Like, so if it didn't work out, you could sell it?
Yeah, figuring that out along the way, or leaning on my mom, my uncle, and aunt for maybe some advice around that.
Right.
Really having something of my own to kind of work through and chug through along the way.
Yeah.
What didn't work, plenty of those stories.
Right.
What did work, and that always doesn't repeat itself.
Give me an example of a story that it didn't work. Was it a tenant story? Or?
It was a tenant story where a colleague of mine said, hey, please do me a favor. These folks, their place is kicking them out. Seemed unfair at the time from her story to me. Looked at their information. I was like, on paper, they don't look like exemplary residents to have.
Qualified.
Want to do a favor for this agent. It seems like they're in a tough, a pickle of a jam. So yeah, here we come. Our property was one of them were vacant. So we made the connection, and it just did not work out time after time, and we had to come to a conclusion.
So no rent or late rent?
Late rent, time and time again. We had to meet the tenant to pick up the rent. Some landlords are perfectly fine for that. That really didn't jive with
the way you like to do things.
Yeah, and our schedules. There was always a story around things. And, every landlord is different. There's no one rule works for everything. So that's, just a trial and tribulation. So we always earmark that story and think about that as we move forward.
And so how painful was it to kind of extract yourself from it, besides the learning of it, which you're like, we won't do that again. We're really but did it take a long time?
Fortunately, we were able to, it was weighing on us, and we were able to move through that, I thought, thinking back, rather swiftly, and we had some strong ideas. While it was painful at the moment, we were able to move through that.
Before it got worse.
Yeah, maybe some might say it already got worse, but it could have gotten way worse, right? So, we were able to do some things to cut our losses.
Okay.
And that was a great positive learning experience, because I had to do that one other time.
Right.
And it worked out well for me.
So that's, I think, important to kind of reiterate. Sometimes there's losses. Sometimes you have to say, okay, we're gonna stop the bleeding now.
Yeah, that's a great term. And speaking of losses, or maybe not gains,
right?
I think for the first maybe 10 years of owning those two properties, I probably didn't make any money at the end of the year, with maybe some maintenance pieces. But I always, trucked forward and moved forward on things. And in time, I knew, okay, I'm pretty sure this is going to come through for me. Right. This is going to work out.
Well, I've heard you say before, and maybe you can speak a little bit more to it, but you're in long game. This is not, and I mean, we're in the last couple of years, I know I've had some investor friends who, they make very big money quickly. And so we're now been kind of spoiled in this market, because you bought something 2 years ago and now it's worth 100 more than it was 2 years ago. So with your 20 years experience, that isn't always the case.
Well, I'm not looking at that always. I feel that every year the market goes higher and higher. When it does, there's always a chance for us to cash out, right? Always. However, I look at it as, all right, they're generating me income every month now, and I can always cash out in the future. If I don't need that money now, well, then what's the point, right? If I don't have another avenue to yield a higher rate of return, let me just ride it out.
Or a diversified rate of return, right? Sometimes you might be looking for that. You might say, okay, I might be a little bit property heavy, and I might want to try
something different.
Put something in.
Yeah.
I mean, that's...
Some of the savvy investors, I think, look at overall which investment vehicle, and we're not even talking about real estate at this point, which investment vehicle, maybe it's your own investment property, a multi-unit, a commercial property, a high interest yield savings account, and many of the
money market.
They're always reevaluating what's going to yield me the highest interest rate of return. That's going to be a savvy investor is going to do that. Then do I liquidate that real estate and move my money into that? So always kind of reevaluating and seeing what's best use of your dollars.
With the investors you're working with, besides your own investment portfolio, with the investors you're working with, do you feel like this current market is prohibitive, or do you still think it's valuable to get into as an investor?
Yeah.
Because the prices are higher, there's more competition. inventory is still low. So where do you fall on that? And what do you feel?
I had a conversation last night with a real estate investor, and he's like, how could somebody invest in current day real estate market? It doesn't make sense. Prices are high, interest rates are high. And I totally get that. From that, yes, values are at an all-time high. Looking back historically, they always tend to be, right?
Yeah,
The curve
we're just catching up to that 4% a year from that '08 crash, right?
Exactly.
And we're right in line with that. So yes,
so if you continue though to look at that curve or that uptick in line, my thought, and this is obviously a projection, is that it will continue to tick up. While I understand some several years might go down in value.
Or stability, or the economy may stall.
I just keep riding it. Keep riding it, keep riding it, keep riding it. Because I know over time, historically speaking, it's always gone up. So personally, we're not ones to... we tried it once to cash out on a property. We're just going to keep riding it, because when we do finally sell it, if we do, if we don't will it to as like a legacy to our children, we know we'll get to cash out on that point. But all the time in between, we were able to make write-offs, and all the time in between, we were able to make money every month, every year. So it's like, to me, like a trifecta, right? You will be able to cash out on it. You're making monthly income, and you're also having some tax write-offs. So in my mind, that's how I look at it, being like a win-win-win.
Right. Even if it costs you along the way, even if it's a little tighter.
Even if it's a little tighter.
Now, so back to the investor you were talking about last night. If you get in very high, right, which is possible right now. Speaking, if you get in high and you had to multiple and you had to pay more than, you couldn't just lowball it, more than, market value or even a little bit higher. But then you turn around and set it up for rentals, you feasibly should get higher rents.
Exactly.
Are you finding that?
I am, without a doubt.
So it's still okay.
Yeah, traditionally speaking, if you're buying cash, right, you don't really have to think too much about the mortgage interest rate for your investment. And even if you do, while rates might seem high, considering the past 5 years, we experienced 3s and 4s.
Crazy low.
Yeah, historically speaking, on average, we're really right at that. A smidge over average. So
for the investment mortgages.
Exactly. Right. Well, they're a smidge higher, but the investment mortgage interest rate is always going to be higher than an owner occupant interest rate. But they're still about average, I would say, both of those historically speaking. So while values might seem high to people, interest rates high, yes, this is the highest time that we will see prices right now that we've seen them. But what's to say what will happen in the next 10, 20, 30 years? And that mortgage interest rate, traditionally, on average, I would say right now. So I think about, to your point, the rents are experiencing the same thing. They're also at an all-time high. So if they're at an all-time high, how is it any different than before? I think mindset-wise, it's different because maybe when that person bought their initial investment, they can't believe all of the raise in value, right? Wow, look at that. I started my investment portfolio at an $85,000 property, and now for that same property, it's $200,000. But also then your rent is higher. So there will always be a time where values are at the highest. Will they continue to go that way? Most likely with inflation, with the cost of things. Just like when our parents were younger, bread cost 15 cents a loaf or something. So I think about that.
And even if the bottom fell out, right? If the sky fell, like everyone sometimes says that might happen, you still have built up that equity all those years, and you still would break even if the whole thing tanked.
Yeah.
Right?
Yeah, you hope so,
Yeah.
right? And you have to look at that before jumping in sometimes too.
Right.
What's the best strategy for this? What if things do take a turn?
Right.
What are my options for the property?
Do you track that every year and reevaluate?
Sure, Claire. No, I personally don't, but I'm sure I should be.
No, I thought you were saying, yes, I definitely do. But would you recommend that? So if you would track those numbers every year and kind of see where they fall.
For sure.
So that it can help project. I mean, obviously, your experience has been positive.
It has.
And you would recommend it.
And jumping back to your question about, is it the best time to buy? I mean, my husband and I, we just recently, so we have 7 properties in total, and 2 of those we bought in the past year, where people thought, oh, the market's so high, I can't possibly use this as an investment vehicle. So I thought that was an interesting thought. Yep. And there are several other investors I know who have done the same. Typically, for an investor, you always want to buy low. I get that. What does low mean? That's very subjective and so on.
What's your perception of, you're making me want to go out and look for investment properties. What is your perception on how solvent you need to be? I mean, I think sometimes people think that investors have, bags full of cash that they just throw at things, but you can start slow.
Yeah.
You can get a mortgage.
Going back to my story,
right.
That was extremely slow start.
Right.
I mean, it took about 10 years to even have any traction. 10 years. Some people would have thrown in the towel year 3, year 2, year 5.
Right.
I knew.
Did you feel that pain early on?
At times, yes and no. I mean, that wasn't my only gig, right? I knew I had to have like my mainstay, my work, my income. Mm-hmm. So it was money I knew I was putting hopefully to good use over time. And there were times where things were quite tight. Just having these properties, I knew I could sell them, get my money back, if not a little bit more. And I chose to grind it out.
Yes, I like that. Okay.
Yeah.
With the idea of what you had seen with your uncle and mom, and that you're like, okay, if it pinches a little bit, but it would be worth it.
Yeah, for sure.
Yeah, I like
for
that.
Sure.
I like that. Because I know I have grown-up kids who are, in their late 20s, and their kind of sentiment or their perception is often, we won't be able to afford a house like you did. And I am wondering if that really is as true as they feel. Because,
I think I can see that their income is also typically going to be relative to...
It's like they're way higher
than what we may have had. And while the purchase price of the house when we initially bought was lower, right, our income was also lower.
Yes, yeah.
Right? So to me, it's all somewhat relative.
That's how I feel, in that it would be, maybe instead of throwing in the towel before you even look, I think there is room. And I do think that we're going to have, especially with this idea that we've been talking about in real estate, that we're going to have more American citizens over 65 than under 18 in the next 10 years.
Yes, and you make a good point. I do think that the average age to purchase is getting a little older, right? It's not going to even younger. It's the
and
age
people are working longer, and as we sunset our baby boomers, there's going to be more room in the market. So, I feel hopeful, but then again, I tend to be that way.
So speaking of somebody who might be just starting out or coming out of college or just getting their feet wet with their first career, in my mind, I think, oh, beautiful. They're a perfect candidate to maybe get a multi-unit, or take a property and split it up into a 2-unit or something. There's going to be some capital there that's needed. But then rent out the other properties. So maybe their portion at the end of the day for their mortgage is 0. All of the other units are helping to offset that.
And then they have that property as they move on to their next things.
That's right. So that's a good foot in the door, I think, for an investment property.
I like it.
Yeah.
All right. Where else? Have we covered all the things?
Oh, how about financing for investment versus an owner-occupant home?
Yes. Yeah. Let's say a little bit more about that, because it's different. It
is. Again, I'm not all knowing. However, the mortgage interest rate, if you're getting a mortgage, so I'll speak to that. Some investors only buy cash, or with their cash, with other people's cash, as a partnership with the other person's cash. So there's a lot of ways around that. If you're doing it yourself, getting a residential mortgage on a truly investment property, one that you're not going to live in, the interest rate is traditionally higher because the bank, the lender, is looking at, okay, it's more risk to them.
Risk factor, sure.
Yeah, if you have your own home you're living in and one you're renting out, if things hit the wall and things go crazy, not good, what's the first property that person is going to not stop paying on? It's not going to be the one where the roof is over their head. It's going to be their investment property. So usually those interest rates are a bit higher. I just had a conversation with my trusted lender partner yesterday, and he was quoting at the time, and again, everybody's different scenario, but it was like 7.75% versus maybe an owner-occupant could get like maybe 6.75%.
Yeah.
Again,
about a point.
roughly, down payment is traditionally higher. So 20% or more, sometimes 25% or more down as a payment is what they're looking for to move you through that process. You can get in at a lower percentage. The lenders, generally speaking, might be charging points to buy down the interest rate. So that's additional cash that the buyer must outlay. Right. So you want to think about that too, in order to keep the interest rate at a feasible point for you. So that's
something to consider. Or,
something to consider.
Look into.
Yeah, a note I wrote is that I also said cash is king, because when you're buying with cash, you don't have to worry about lender overlays, appraisals. Yeah, there's no second person kind of like monitoring thing, tells you how it needs to be. But you might want to use the cash. And even if you have enough cash, you might still choose to get a mortgage on a property if you're looking for maybe interest write-offs. So it depends on if you want to outlay your cash, or if you have a different investment vehicle that you want to put your cash and maybe still use a portion of it for a mortgage to buy that investment property.
And in the banking climate right now, I think that's been sort of encouraged to be a little bit more conservative about the borrower's cash outlay, so that the banks can be a little bit more solvent that way. So I think we're seeing that a little bit. It just depends on how much you have and where you can put it and where you can find it. We'll talk a little bit more about the tax write-off for investment properties. I know there's a vehicle, right? So that if you sell something, and if you buy something, that you can kind of get a tax break. Yeah,
so again, as an investor, if you're looking at one property and saying, okay, it's yielding me a nice rate of return on that, but I see this other property over here, and when I do my numbers on that, that rate of return is projecting even higher.
Right.
I'm looking at my accounts and I don't really have all the funds to keep that and go and jump into this investment. What do I do? It's possible you can do something called a 1031 exchange, and that allows you to sell the, let's say, smaller investment and not have to pay taxes on the gains right now. It allows you to move all of the gains right to that
So there's a time frame window. So, okay, I want to get into this little bit bigger investment. It's going to have a higher rate of return. So I'm going to, but I don't have enough cash up front. I'm going to sell this one, and if I put it, I won't have to pay the gains on that one if I put it toward the new one within a certain time frame. And what is that, 6 to 9 months? It depends.
A little lower than that. Don't quote me on this, but it might be 6 months that you have to identify a property.
Okay.
And then let's say like 45 days.
To settle.
Yeah, to go to closing.
Okay.
And then you can keep doing that. You can keep doing that time after time. Let's say now, 10 years later, you're on to that second property or whatnot. And you're like, well, over here, this one's yielding me even higher. So Although some investors will say, I'm keeping that one, I'm going to buy this one, and I'm going to go get that one.
That's a lucky investor.
That's a great way to do it as well. So there's all those little pieces, and I don't just know about that on my own, or I did research, but tying to another question that you were asking initially, like, who are your partners, like when you're owning,
that's a good
or when you're looking to invest, right? So in my mind, there's a bunch of different people that you kind of have to build out on your team, so to speak. Having a trusted lender is going to be a major point to that. Even if you have the cash, again, just be able to talk through those options of, do I go get a mortgage? Do I use my cash? Do I do a little bit of both? So to know what that looks like, I think is always a great option. So great lender partner. Absolutely, contractors is trusted contractors is a must-have. People who are going to have your back.
Do you use property managers?
I was just going to say, we are our own property managers for our properties.
But you know of investors who use property managers?
For sure. If they're not local, or if they don't feel comfortable managing it themselves, they don't want that interaction with the tenant. They feel some kind of way. They want a third party, kind of intermediary. So contractors are a great piece. Sometimes I don't even go see the issue. Hey, tenant, send me the issue. Do a quick video, and then, hey, contractor, here's the video. Could you run over there? And they repair it without physically having to be there. So I think contractors for sure. Realtor is a great one.
Yes, good partner. Yes,
great partner. They might help you. A savvy one who might specialize in investment properties are really going to be able to see the numbers before you even go out to see the property, and also keep you up to date on values, like where are current values. Could you do a cash out refi on that investment property, use that money to go
on
buy
the investment properties you already own that you might revalue for that?
That's right. Let's say you have no mortgage left on a property, and you can put a mortgage on that property, take that money, so cash out, and go buy another property. That's a whole nother way to do it. And I love that thought as well. Take that money, and I'm going to go buy another property. So I think a realtor is going to make a great partner for the properties. They're going to keep you up on values, or, hey, this one looks interesting. You might want to take a look at this property. I know you like this area, or these types of investment properties. I also thought insurance person was another great piece, and how to kind of limit your liability. Tax accountant, I think, is going to be important too. Do you file taxes all together, or do you have an LLC and have to file for yourself personally, or under your LLC with your investment properties?
Partners. And how about resources?
Oh yeah, thank you. So
these are great.
If you're not an investor and want to consider it, I think this is like a little Bible of a book. Rich Dad, Poor Dad by Robert Kiyosaki. As you can see, it's well used, lots of notes, things underlined.
That's one's been important for you.
Yeah, it has been great. I think I read it after I got my first investment property, but a lot of people were touting this. And this is more about mindset of someone who's very playing it safe, kind of conservative. Conservative, operating from a limited mindset, to another person who's saying anything's possible. I want to go do this. Now I just have to figure out how I go from here to go do that.
Even if it's a little risky.
How to make that happen. So that's an abundant mindset, right? And so this is a really cool book. And to revisit it time and time again. This other book is called The Millionaire Real Estate Investor by Gary Keller, and he has a couple people who helped him put it together.
It's a good one.
This is a good one too, for sure.
And that one also is a little bit more of a how-to, and it starts you kind of like your story, right? Start off with manageable pieces.
For sure. I think this seemed to be more of a story with examples in it, for sure, and more of a, like you said,
anyone can do it.
How to. Good Thank you for picking those out. Thank you for having me and picking my brain again on some of these investments.
Thank you for working on this topic. I love our topics. I think We always get to things that I've been chewing on and thinking about, and it's really great to have these conversations with you.
Yeah, my pleasure. And I guess we'll see each other next month.
Yeah, absolutely.
Yeah, thanks, Claire.
Thank you.
Thanks all.